Hey there, future investors. Have you ever wondered how to kickstart your financial journey in your 20s? Today, we're diving into how to start investing now so you can set yourself up for a lifetime of financial freedom. Whether you're a complete novice or just looking to refine your approach, this guide is packed with practical advice that anyone can understand. Let's get started with a question. What if I told you that investing in your 20s could potentially double your wealth by the time you retire? Sounds too good to be true, right? But trust me, it's possible. First, let's talk about why investing in your 20s is so crucial. Imagine you're 25 and you start investing just $200 a month. With an average return of 7%, the historical rate of the stock market, you could have over $200,000 by the time you're 65. Now, if you wait until you're 30, that same investment could be reduced to around $150,000. The earlier you start, the more your money can grow. Now, you might be wondering, what should I invest in? Here are 3 key options to consider. 1. Stocks. Think of stocks as rockets, fast and exciting, but they can be unpredictable. When you buy shares in a company, you're essentially buying a piece of its future. Look for companies with strong fundamentals and growth potential. Just remember, while they can provide high returns, they also come with higher risk. 2. ETFs. Now, let's talk about exchange-traded funds, or ETFs. Picture ETFs as a steady ship built to weather all kinds of financial storms. They're a collection of stocks or bonds that trade like a single stock. They offer diversification, which means you're not putting all your eggs in one basket. This can help reduce risk, especially for new investors. 3. Robo-Advisors. If the idea of picking stocks sounds daunting, don't worry. Robo-Advisors are like having a personal financial assistant at your fingertips. They use algorithms to create and manage your investment portfolio based on your risk tolerance and goals. You answer a few questions, and they handle the rest. Now that we've covered investment types, let's talk about assessing your risk tolerance. This is super important. Are you more of a thrill seeker or someone who likes to play it safe? Knowing your risk tolerance helps you choose the right investments. If you're comfortable with ups and downs, you might lean more towards stocks. If not, consider a mix of ETFs and bonds. Next up, let's consider your time horizon. This is how long you plan to invest before you need to access your money. The longer your time horizon, the more risk you can typically afford to take on. So, if you're in your 20s, you have time on your side. This means you can invest more aggressively and ride out market fluctuations. And what about your financial goals? Are you saving for a car, a house, or retirement? Setting clear goals helps you choose the right investment strategy. For short-term goals, you might want safer options like bonds or high-yield savings accounts. For long-term goals, stocks and ETFs could be your best bet. Now, here's a relatable story to illustrate all this. Imagine Sarah, a 25-year-old who starts investing in a mix of stocks and ETFs. She regularly contributes $300 a month. Fast forward to age 65, and her investments have grown to over $400,000. Meanwhile, her friend Mike, who started investing at 30 with the same monthly contribution, ends up with around $250,000. That's the power of starting early. Before we wrap up, remember to keep learning. The investment world is ever-changing, and staying informed is key. Follow finance blogs, listen to podcasts, and maybe even read a book or 2 about investing. So, what are the key takeaways? Start investing early. Choose the right mix of assets based on your risk tolerance and goals, and keep learning. Now, I want to hear from you. Are you ready to start your investment journey? Drop a comment below and let us know what you plan to invest in first. And stay tuned, because next time, we're uncovering an asset class you might not be paying attention to. Trust me, you don't want to miss it. Happy investing.